What can we expect from the upcoming Federal Reserve's decision on interest rates? That's the big question on everyone's minds. The Federal Reserve, or the Fed as it's commonly known, is expected to raise interest rates by 0.25% at its policy meeting in March. This decision is not arbitrary. It comes amidst the Fed's ongoing efforts to combat inflation, which has stubbornly remained above their target of 2%. Now, why would they want to do that? The primary driver behind this anticipated rate hike is inflation. Now, inflation is a term we're all too familiar with, but let's dive a bit deeper. Inflation is essentially the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. Over the past few months, consumer prices in the United States have shot up significantly. And what's causing this hike in prices? Well, there are a few culprits. One major factor is supply chain disruptions. You see, when the supply chain is interrupted, it creates a domino effect. Goods become scarce, production slows down, and as a result, prices go up. Another significant factor is the ongoing war in Ukraine. Wars have a profound impact on global economies and markets. They disrupt trade, cause uncertainty, and can lead to higher oil prices, all of which contribute to inflation. So the rate hike is an attempt to rein in this runaway inflation. Higher interest rates can have a wide range of effects. For starters, they can temper economic growth. How, you may ask? Well, when interest rates climb, borrowing becomes more expensive. This means businesses might think twice before taking out loans for expansion or investment. The same goes for consumers. Higher interest rates could lead to less spending on big-ticket items like homes and cars, which are often purchased with borrowed money. But there's another side to this coin. Higher interest rates can help reduce inflation. Here's how it works. When borrowing is more costly, demand for goods and services tends to decrease. This can lead to lower prices, which in turn can help curb inflation. So while the rate hike might slow economic growth, it could also serve as a valuable tool in the fight against inflation. There's no denying it. This move by the Federal Reserve is a bit of a balancing act. It's about addressing the immediate issue of inflation, while also keeping an eye on the health of the broader economy. Thus, the rate hike is a double-edged sword with potential benefits and drawbacks. Financial markets have already priced in the expected rate hike. It's as if the market players have a crystal ball, anticipating the Federal Reserve's next move. The focus now is not just on this imminent increase, but on the central bank's forward guidance, the signals it sends about potential future monetary policy decisions. But it's not all clear sailing. The Federal Reserve is navigating through a sea of uncertainties. The pace of inflation, for one, remains a wild card. While the rate hike aims to cool down inflation, the exact speed at which this will happen is unpredictable. Another shadow looming over the horizon is the potential for a recession. Higher interest rates, while good for quelling inflation, can be a double-edged sword. They can make borrowing more expensive, potentially slowing down economic growth. So the Fed finds itself walking a tightrope, balancing on one side the need to control spiraling prices, and on the other, the need to keep the economy humming along. In the end, the Federal Reserve will need to carefully balance its efforts to control inflation with the need to maintain economic growth. In a nutshell, the Federal Reserve's decision on interest rates is a key determinant of the economic landscape. We've discussed the anticipated rate hike's primary catalyst, the need to curb inflation, driven by factors like supply chain disruptions and the war in Ukraine. We've also considered its potential impact, which includes slowing economic growth by making borrowing more expensive, yet also reducing inflation by damping demand. We've touched on market expectations and uncertainties, highlighting the delicate balance the Fed must strike between controlling inflation and maintaining growth. While the rate hike is a complex economic issue, understanding its potential implications can help you make more informed financial decisions.